Hello, let's look at chapter 17, which is job order costing. 17 is about job order costing. Chapter 18 is about process costing. And so let's go ahead and look at the pre-lecture, and I'll sort of lecture about this chapter as we go through there. So let me share that screen here. This first exercise is going to compare process and job order. When we talk about job order, it's sort of like a construction site, like building like our stadium here for football. That would be considered a job order. Or if you're a company that's building yachts, made to order yachts, because they typically aren't an assembly line type, so like an individual project going on. And process costing is more like what we did at Exide and Lear, where you're making automotive seats or you're making batteries, something, or nuclear fuel, or the fuel process is a continuous process. And so the costing is a little bit different between the two. There are a lot of similarities, but there are some differences there in how we allocate overhead. And that's a topic that we're going to look at in these two chapters, is overhead allocation. Remember, the big three is our direct material, direct labor, and overhead. And direct material is traceable, right? That's why it's called direct. So if I stop share this and put that up, direct material, direct labor, and overhead, direct material and direct labor are traceable. So it's pretty easy to walk out on a production floor and know who are your direct labor people, who are actually building your product, whether it's a yacht, a battery, working the fuel process, making automotive seats. Same way with material. It's very easy to see what's direct material that's going into your product. The problem is the overhead. And overhead is like I'm going to put on here a bucket where you collect all of the indirect costs. Things like electricity bills, maintenance and repair costs, wages like supervisors, environmental, material handlers, janitorial. I apologize for the noise. They're out here working on cutting limbs out of trees, so hopefully you can hear what I'm saying. So overhead is what's not traceable. And you have to collect that into a bucket, more or less, and then allocate that out in some rational manner. Well, how is it normally allocated out? Usually through direct labor. Not always, but direct labor. Maybe direct labor hours is normal, is what most companies do, or direct labor dollars, which is similar. You know, you hear about ABC costing, things like that, but that's not as prevalent as just using a very simple way to allocate based on indirect labor, or excuse me, direct labor. All right, so let me go back here and share. That again, and what I just showed you, direct material, direct labor, and overhead, that is for job order and process costing. It's both. That was just what I showed you here on this legal pad. That's the concept here for both of these chapters. So when you look at process costing and job order, what is a cell phone manufacturer? Well, they're making a lot of, they may have a lot of different types of cell phones, but in essence, here, a cell phone is process costing, and advertising agency is job order, because advertising is going to be each individual project that a company or an advertising agency has is going to be a separate cost collection. 2, what process do you go through here when A manufacturing company uses direct material, assigns the cost by debiting what? Work in process. You remember that from the last chapter. Work in process is inventory, so you're debiting work in process. And you credit raw material. But you debit work in process, credit raw material. So it comes out of raw material and goes to work in process. Okay. Part of the issue that we have with overhead is you don't really know what your overhead is going to be till the end of the term, whether it's the end of the month, end of the year. Of course, it's too late. You're building product and selling that all during the year. So we have to come up with a predetermined overhead rate in order to cost our product even before we know exactly what it's going to be. So that's why budgeting is so important. And we're going to get into budgeting on the last exam in those last few chapters, 22 and 20, 21, somewhere along there. But here it says, what's the predetermined overhead rate? Meaning, what is my budgeted rate? Well, the estimate is we're going to have 9,000 machine hours and $88,000 of manufacturing overhead. Now, $88,000 is electricity, it's all your indirect labors, indirect materials like maintenance and repair. So we come up based on that with a $9.78. So every time I have actual machine hours during the year, actual meaning what I actually incurred, I'm going to allocate $9.78 to my product, whether it's job order or process, because I have to allocate this during the year. So I'm allocating out of the right side of my T account. Let me put that up here. And I'm accumulating that on the left side. So what you see there with my T account here, manufacturing overhead, you know, the left, what you see there on the left is your debits, right? I need to put that there. The right side is your credits. So what we're allocating out, that predetermined overhead rate, right there, we're going to allocate out based on machine hours. So every machine hour for that particular department is going to be allocated out to your work in processes or to your job order. And at the same time, we're going to, you know, 2010 accounting said, as I have these various expenses, whatever I actually pay for my electricity, what I actually pay for maintenance repair, what I actually pay for my indirect labor, I'm going to accumulate on the left side as debits, you know, debit expense. And then this manufacturing overhead at the end of the year or end of the period should be zero. But if it's not, then it's either underallocated or overallocated. We're going to see what do you do in that situation. So if my budget's accurate, right, my predetermined overhead rate is accurate, and if my allocation based on actual hours is accurate, this should be zero at the end of the day. Of course, it's not. It's always going to be a little bit off. You have to true that up at the end. So we'll look at that as well here as we continue on. But I just want to make that point. Very important. All right, the next one here. You can read that for yourself. Says the company allocated manufacturing overhead $154,000, used a predetermined overhead rate of $11. The total actual manufacturing costs are $84,000. So what do you have there? You have a debit balance, right, of $84,000. And they allocated $154,000. And so you've got a what? Is that $70,000 balance? And so what entry would they make to adjust the manufacturing overhead? There's the balances that I was just talking about, 154. So I allocated out more than I had actually coming in, which that's a good thing from the standpoint that my actual cost, right? My actual costs are less than what I allocated out, but I've got a balance there of 70,000. Well, how to get that $70,000 off? Well, I got to debit manufacturing overhead, don't I? And it always goes against cost of goods sold. So I debit manufacturing overhead for 70,000. I credit cost of goods sold. So in essence, I've lowered my cost of goods sold, haven't I? But what's the issue there as well? Looking at this from a business leader standpoint. I've been allocating this cost out to my product, and I actually have over costed my product. I may have made some poor sale decisions based on, I thought my cost was higher, and actually it was lower, wasn't it? All right. So there's my debit to manufacturing overhead, to zero that out and take out, and it always goes to cost of goods sold, right? If I'd had a $70,000 debit balance, meaning my actuals were more than my allocation, then this entry would be the opposite. I would debit cost of goods sold and credit manufacturing overhead, right? Manufacturing company completed work on a job. The cost of the job is transferred into what? Finished goods inventory is a debit, and it's a credit to work in process. And lastly, which reasons? Well, there's no inventory, is there? Again, managerial accounting is not external. It's all internal to run your business. That's why this is so important to all of you, not accounting majors, but everyone. Management, marketing, you've got to understand what's going on in your business from a number standpoint. How much you charge fees to clients. All right. Let's go to the next assignment. All right, here is just several of these various companies, and you've got to designate whether it's process, manufacture refrigerators. You know, that's pretty standard. Even though they may have a lot of different types, like Whirlpool or Maytag, it's still a process. Especially wakeboards, job order, luxury yachts, job order, professional services firm, job order, landscape. They're going to have a different cost for every landscape job. See the answers for that. All right, number 2. Begin by recording the journal entry for the purchases of materials. So again, this kind of a 2010 question, raw materials inventory, debit for $69,600. There's my $69,000 purchase of canvas, and it's lubricating oil on account. They're putting that in raw material inventory, but in essence, it's not going to be traceable. We'll see that here in just a minute. 69.6 of materials used. So there, 63,000 is coming out of that inventory and going to work in process. Still inventory to inventory, but then that $200 for lubricating oil, they just consider that insignificant or immaterial. So it's just going to be put in that big bucket, right? A debit to manufacturing overhead. You're accumulating costs on the left side, accumulating expenses on the left side is debits. And then there's my raw material inventory. It's got to come out how it went in. Then they show here the T account, which I like. The beginning balance, 31,000. Our ending balance, I guess what we're calculating. But there's my purchase, beginning plus purchases, going back to the previous chapter and that, you know, that algorithm that we looked at. Beginning inventory plus purchases plus freight in is goods available minus ending inventory is what's been cost of goods sold or what's been used. Same algorithm here. Beginning balance, purchases, we just calculated or it told us how much was used. So there's my ending balance. That's what I should have on hand in dollars. And you can do this on units as well. Now at Exide, I was a controller and I was all up about the dollars and so forth. But the materials manager, who I guess we call that supply chain logistics now, he was always concerned about units like pounds of lead and liters of sulfuric acid and various components. So of course he knew there was dollars associated with it, but you use these same calculations or same algorithm for both units and dollars. All right, number 3. I think this is just sort of a fill in the blank. If you began with 35, you purchased 215, and you end up with 10, then that means you must have used 240, right? This basic chart we used last time. Different numbers, beginning inventory plus purchases, plus freight in. Well, I'll add that in. Goods available minus ending inventory is cost of goods sold. Same formula. We use that for raw materials. You use that for a company that is his purchases, like sales or a merchandising company. You use it for cost of goods manufactured. Use it for finished goods. The cost of goods sold is the same formula. Over here we got a beginning balance, an ending balance, cost of goods manufactured. So you're really grouping all of this, direct materials, direct labor, and overhead. All 3 of those are being grouped as one to solve for this, right? Yes. Purchases over here, raw material, it's the same algorithm, but you've got to group all 3 of those together. So if you began with 25, right? 505 came out, leaving 40. What does this have to be? $25 minus 505 is equal to 480 and 40. So that's got to be 440, right? And so 280 and 150, what is that? Did I do that backwards? I believe I did. 25 plus 520. 25 plus 520 minus 550. I still did that wrong. I can't add this up. $90 and 280 is 370. That's 520. All right, 25 plus 520 is 545 minus 505. There's my calculator, leaves 40, right? So 25 plus the total of these 3 minus this is equal to 40. So the total of these 3 has to be what? $520. So if the total has to be 520, 25 plus 520 minus 505 is 40. If this is 520, well, 280 and 150 is 430. So that's got to be 90. Indirect materials used, 240 minus 90, 150. All right. Journalize these transactions. Plant janitor's wages. So that's indirect, right? Plant furnace operator's wages, 860. And glass blower's wages, 74,000. So it looks like they consider only glass blower's wages as direct labor. And the other 2 they've grouped as manufacturing overhead. I mean, you can make the case that plant furnace operator's wages would be direct and should be part of the 74,000, but Pearson doesn't look at it that way. All right. Job 303 includes costs of 460, direct material 460, direct labor 430, and their overhead allocation is 60% of direct labor costs. So that's how they're allocating that big bucket called overhead, 60%. So 60% of 430 is 258. So there's my total cost. Number 6. Here that they estimate, again, they're talking about budgeting, predetermined overhead rate, 65,000 and 5,000. So they're going to allocate $13 every time one direct labor hour is used. That's what's coming out as a credit. All right. So if my actual, that's the key term there, actual, see it? This is based on estimated. But when you actually start incurring these hours, 13 times 4,500, 58,500. That's what's coming out of the right side of your manufacturing overhead. And so that's how it gets allocated. There's my credit for 58.5, and there's my debit to work in process. So it's coming out of manufacturing overhead. I call it a bucket, but it's really just a holding. It's just a holding tank that has to be zeroed out at the end of the period. Always remember that. I mean, I can't show this enough here on the screen. Manufacturing overhead, you're allocating out on the right side, and on the left side, you're accumulating actuals. It's good stuff. It's real world. Number 7. I guess that's already there, so let me click on this. All right, so there we got a manufacturing overhead. So what's going on the left side? Those are actual invoices or paychecks. Right side, 53,300. That's what's been allocated based on a predetermined rate. Because you can't wait till the end of the period to find out what all these actuals are. You're costing your product all during the year. So the actual manufacturing overhead is 51.2. If you add up 3,200, 13,000, 35,000, that's my actual bills incurred, accounts payable and payroll. I allocated 53, and so I've over allocated by $2,100. Right, 2,100. And so to get rid of that, we would what? Debit manufacturing overhead, credit cost of goods sold. They don't ask that, but that's what you would do. 8, get another T account. Actual manufacturing overhead, 209,000. Allocated manufacturing overhead, 202. So you have what? You've had $7,000 more in actual costs come in than what was budgeted. That's not a good thing. I can tell you, having worked in a plant for so many years, that's the last thing you want to see as controller or as a general manager. Underallocated, because that means you're going to what? What's the journal entry? You're going to credit manufacturing overhead by $7,000 to make this balance to zero. And what's the debit? Cost of goods sold. You've increased your cost of goods sold by $7,000, an unexpected expense that comes right off the bottom line. All right, so that's practice set 1. Let's see practice set 2. Make sure I'm sharing this. All right, some journal entries here. $44,000 completed. So it comes out of work in process and goes to finished goods. Goes from one inventory account to another. All right, booking my sales revenue. Accounts receivable, that's a 2010 question. Cost $43,500 to produce, so that's what's on my books, right? So that comes out of finished goods, right? Comes out of the finished goods, comes off the balance sheet. That's balance sheet, right? Comes off the balance sheet and goes where? To my income statement at cost. But we sold it for 89. So what's our gross margin? 89,000 minus 43.5. That's our gross margin. Sales revenue minus what? Cost of goods sold. Number 2, another T account. How do we clean this up? You got a $3,000 debit balance. So you got what? Credit, manufacturing overhead, and it always goes to cost of goods sold. Always. Bricks Advertising pays Thomas Tibbs $84,600 a year. What is the hourly cost of Bricks? If employee Tibbs assume a 45-hour week and 47-week year. So they're looking at 45 hours times 47 weeks. So there's potential 2,115 hours. So they should charge $40 just to cover his salary, right, on all these jobs. So if you got a 14-hour job, $40. My actual cost, right, this is cost. This isn't profit. This is just the cost, $560. Then from there, you decide what you're going to charge in order to have profit for your company. Number 4, getting back to some of the stuff we had in chapter 16. Beginning working process. Again, here's this algorithm that keeps popping up, and people think, well, there's like 4 different ones I have to remember, like raw material and work in process and finished goods, cost of goods manufactured. But you don't. It's the same algorithm. Beginning work in process. If it was purchases, you wouldn't have any of these 3. Right? But you're making this product. So you've got, instead of purchases as a one line item, you got material, labor, and overhead. The big 3. 51, 31, and 19. 101, that gives me 112 to account for. If my ending work in process is negative 19, well, 19, that's kind of confusing, then I must have manufactured $93 worth of product. And in my income statement there, sales revenue 420. There's my beginning finished goods, 10,000 or $10 plus 93, we just calculated, right there. Cost of goods available for sale. There's my ending inventory. So I must have sold $87 of those units. Gross profit, sales revenue minus COGS. It's gross profit minus my SG&A gives you my net income. That's a little bit different format than what you had in 2010. This is your cost of goods sold format, which is used by manufacturers primarily, but also, I guess, sales as well, but or merchandising, but really manufacturing. This is, and you can do this based on GAAP. It's not anything wrong with using this. You can do this based on GAAP. All right, number 5, and this is sort of a puzzle. If I've got 30,000 beginning and ending 1,500, that's got to be 28.5. Same way here, 47.50. If I add back to 33, or yeah, add back to 33, and then subtract the 97.50 and the 5, that's going to give me 23. All right, so all my debits minus my credits must equal this. If that's 3, and some of this you have to carry from what you just previously calculated. I guess we can't do that till we take care of wherever C and D is down here. I guess we can. 33 came out of work in process. Where does it go? Finished goods. All right, if that's 33 and that's 3, then that means that must be 30 credit, finished goods. And if that's 30 finished goods, then that 30 has to go to cost of goods sold, doesn't it? So this is a very good exercise for flow of your product. Wages payable. How do we get 6,500? Well, let's see. Our overhead is 5,500, 1,500, and 9,000. So that's direct. That's probably material related, maybe labor. But 9750 was processed out, meaning that's got to be 6250 to make this balance, right? So the labor is 5,000 plus the 1,500 is 6,500. Labor incurred, direct labor assigned to work in process. Ah, there it is. I see now. Let me make this smaller so I can get it all on one screen. So that has to be labor, 5,000 of labor. Because you always assume that this is direct material, direct labor, and that's overhead. That's the assumption. It doesn't say that on here, but that's always the assumption. Material, labor, overhead. So if that's labor, and when you look down here, but this is overhead, this is material, labor. If that's 1,500 and that's 5,000, then that says 5,000 plus that 1,500 is my 6,500 wages payable, right? Yeah, that's a little confusing. But always remember material, labor, and overhead. So that's my direct labor. That has to be my indirect labor, is the assumption, to make that 6,500. All right, and then finally, number 6. Direct labor rate is the first question. So if we have estimated direct labor costs of 2.8 million and estimated direct labor hours, 17,005, and our direct labor cost rate is $160, what about the overhead allocation? Well, if the estimated indirect costs are 2,520,000, which would be I guess they're adding all of that, even though it's a little bit confusing. Yeah, they're assuming all of that. Office rent, support salaries, utilities, indirect costs. Of course, this is a consulting firm. You know, if this was manufacturing, you would be ignoring all that stuff that's not related to your manufacturing. But the fact this is a real estate consulting firm, all of that is in play. So we want to add up all of the office rent, support staff, and utilities to get our 2,520,000. And for our estimated direct labor costs is what they're basing it on. Percentage of direct labor costs up there at the top, right there. Then that says we're going to allocate 90% or 0.9, right, for direct labor costs. All right, so what does this look like based on this particular project, which is what was it? 250 direct labor hours right there. But 250 times 160 is going to be my direct labor. And once I have my direct labor, 90 cents on the dollar, right? 90% or 90 cents on the dollar is 36,000. So the predicted cost to cover all of my costs, even before profit, is 76,000. And so it's given up here that we want to have a profit equal to 30% of the job's cost, and 30% of 76,000 is 22,800. So required service revenue is 98,800. That's what we have to bill for in order to reach our desired profit and cover all of our costs. Good example there. All right, so number 2. And let's look at the self-assessment for 17. All right, this is a good exercise. It's a long one. What you have here is a data table that's got estimated and actual. Estimated is another word for budgeting. So we're kind of compressing all this of 1 year's worth of data into this one table here. And this is what we have estimated prior to the year. And then this is what our actual results were after the year is over. So the first thing they want you to do is estimate the overall overhead, estimate the overhead allocation rate. And so we start by using these estimated amounts. So which of those are we going to use? Well, we're going to use maintenance labor, 13,000, plant supervisor salary, 44,000. I believe screws, nails, and glue are part of it. Plant utilities. We're not going to use freight out. Remember, freight out is always something separate. It's usually a corporate budget. It has nothing to do with your plan and what you're doing as far as your product. Freight out is after you've already sold it. Depreciation on plant equipment, we're going to include that. And so really the only thing we're going to exclude is the 34,000 and the 41,000. The rest of these we're going to add up. Let me just show you the solution here. But that adds up. There it is. 24 plus 44 plus 30, I don't know why I didn't do it in order, plus 13 plus 49 plus 93.1. So again, we ignore freight out, we ignore advertising expense. So there's my budget. It's 223,100. Before the year begins, that's what I expect to spend in actuals. So that's my budget. I'm going to divide that by the estimated machine hours, right? Because I don't have actuals yet, estimated. So estimated divided by estimate says for every machine hour, I'm going to charge every machine hour in every department, or in this case, just job order, I'm going to charge $7.44. So all these different job orders that I've got. All right, so what does that look like? Well, 744 times actual hours is going to give me 239,568. All right, 744, my budgeted predetermined rate times actual at the end of the year is 239,568. Right there it is, 32,200 times 744. Actual hours, actual machine hours. All right, so that's what's been allocated out. But then we got to compare that against my actual cost. So you've got to populate the left side, again, going back to the very beginning of this lecture. What is my maintenance labor? 28.5. Plant supervisor salary, 47,000. Screws, nails, and glue, 43. A lot more than the 24, wasn't it? Plant utilities, 98,850. Depreciation. So this is what I actually incurred. That left side, actual debits to expense normally, but in this case, it's going to this holding tank called manufacturing overhead. Because remember, we're not expensing this in this environment. We're accumulating this. We are allocating this out. And where is this going when it's allocated out? It's going to work in process. Even though your job order just has one work in process, which is inventory. And when it's sold, then it goes to your income statement as expense, cost of goods sold, expense. See how the flow works? All right. So if that's my actuals, that's the allocated out. Then this says I have what? I had more expense than I had allocated. That's not a good thing. I'm over budget by 62,782. And so how do I clear that off? Well, I've got to credit manufacturing overhead and debit cost of goods sold. I've got to reduce my revenue or reduce my income for the year by 62,782. Not a good thing. People lose their jobs over things like that. But look what it says down here at the bottom. The actual manufacturing overhead rate is not known until the end of the period. Managers need to make decisions throughout the period. You need to cost your product throughout the period. And so you use this predetermined overhead allocation to give managers product cost information when they need it today, to know what can you sell this product for or not. So you can see if you do a poor job of budgeting and allocating, right? Of course, your allocation, depending on what your cost driver is, and cost driver like direct labor is used most of the time. In this case, it's machine hours. That's considered the cost driver. That's the best way to allocate this bucket of overhead out. All right, so that's a good chapter. That's less than an hour. What is this, 9:57? 40 minutes. Not bad. All right, so again, go back and read the chapter, look at the PowerPoint, go through the homework, make sure you understand what's going on there. We had to make some assumptions based on how Pearson displays his homework. So when you encounter these on the exam, you'll know how Pearson is thinking. Even though it may not be as clear, if you work through this and understand what Pearson's doing, then you'll be fine. All right, so we'll get back together here shortly. Have a good day.